Hi, this is Darius Dale, Senior Macro Analyst on the Hedgeye Risk Management Macro Team. I just want to spend a couple minutes today updating you guys on our growth inflation policy outlook on China. Put out a note last night, a detailed 80-slide presentation. Just want to hit on a few of those key takeaways. So, number one, the first takeaway is that the secular outlook for Chinese growth is substantially more dour than I think most people realize. Obviously, China's encountered some cyclical headwinds, certainly with the fixed asset investment side of its economy. We continue to flag those and highlight those. You're actually starting to see some nascent signs of stabilization in Chinese economic activity, but over the long-term tail, you're going to continue to see Chinese growth trend lower for a confluence of reasons, most notably current account degradation and financial sector intermediation headwinds, specifically with the capital outflows becoming an incremental headwind to credit intermediation in China. Sort of the second point we wanted to highlight is this sort of asset class rerotation risk. We coined that phrase about 2 or 3 months ago, and that continues to weigh on Chinese equities, down 24% month over month, down over 40% from their recent highs. So what you've seen is that now what is now a trending acceleration in home price appreciation in China. That's certainly inflected from the midsummer lows. You're seeing demand follow that appreciation, and that capital rather, has flowed out of the stock market and back into the Chinese property market at the margins, and that's obviously weighing on share prices in the context of reduced state intervention. And then lastly, a couple bullish things to highlight from the perspective of really long-term investors. Chinese capital account and capital markets reform is progressing as planned for the most part. Certainly, inclusion in the IMF's SDR basket next year would be a huge positive boon for the Chinese yuan, both from the perspective of foreign institutional and central bank inflows in the Chinese economy, as well as the global economy from the perspective of China's large stock of domestic savings that could obviously become an incremental source of liquidity for global capital markets. And then lastly, obviously, the Chinese capital markets reform is likely to be very positive for the equity markets long term, given the lack of equity financing in China relative to debt financing and state lending. So again, this is Darius Dell here, just wrapping up our latest thoughts on China. So ping us at sales@Hedgeye. I'm at Hedgeye D Dale if you guys have any further questions. Cheers.